From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, February 14th. I'm Tony Fratto in New York City. You listen to a special Valentine's Day edition of the Macrocast on Friday, February 14th. Our partners, John Fagan, Brendan Walsh from Markets Policy Partners are in the DC headquarters. Guys, the coronavirus is the headline every day now. We're seeing, shutdowns of travel. I saw a really good friend of mine, and Michael Farr from the. If you're not listening to Michael Farr's Farcast, I highly recommend it. But I had lunch with Michael yesterday, and he's a longtime markets watcher and thinks that markets seem to be ignoring what is really going on out there in the real economy. Sees this disruption going on for a long time. He is right. I mean, the market has charged on. We saw a dip, a week or so ago, 10 days ago. It's come roaring back and setting new highs. Why are equity markets ignoring this? What do you guys think, John, Brendan?
Yeah, and should they be ignoring it?
Yeah, it's thanks, Tony. Yes, and happy Valentine's Day to everybody. I wish love were the only thing in the air, but COVID-19 also appears to be. It as you say.
Ba-dum-bum.
All right. The two markets are there is certainly a perception among many in financial markets that the equity upside that we've seen despite all of this very disturbing news about the coronavirus spread in China and now in a lot of different places around the world, that the equity markets are dulled to this. It's proof positive to the skeptics that algorithmic trading, which is trading by machines and in factors that take a lot of human discretion out of the investment decisions, passive investing, which is just investors putting money into a broad S&P 500 tracker or something like that, high frequency trading, Fed liquidity injections that we're seeing, these things have dulled price discovery, and they've turned the markets into basically just a one-way bet that automaton-like keeps going up in the face of things that in normal market conditions would be putting investors in a much more risk-averse kind of mood. But the machines don't fear the virus. The high-frequency traders don't fear the virus. The passive investors aren't in that game. And that's the case for the sort of the case for the prosecution, that this is that what we're seeing is not fundamentally driven and is proof that the market is distorted.
Is that because they're using SARS and the Asian flu as the data that they're analyzing?
Well, I think that brings us to the counterpoint to the skeptics. That there's definitely an argument to be made that there's a fundamental reason why stock markets are responding the way they are, and it's not just the S&P 500. We've seen resilience across global markets, even the Shanghai Composite, which clearly there's some potential state support in there. But the Shanghai Composite has retraced much of its post Lunar New Year opening decline, and that is that suggests that there may be something fundamental to it. And I think you point to it there with the case of SARS.
Yeah, and I suppose basically if you're going to sell and think that the market's going down a bunch, you're betting that the Spanish flu is going to happen, that this is going to travel around the globe once, and it's going to have a 2-3% death rate, which multiplied by, say, 25 to 50% of the population getting it is a huge amount of numbers. And that's just a tough bet to make, You just kind of, every time that's happened in the past, we figured out a way, either it petered out or we found a way to kind of quarantine it. And then on the flip side, central banks and governments kind of have a fiscal response to it. So you have 3 months of kind of contraction, but then you have 6 months of party time.
Yeah, that.
Assuming are we expecting to see that from governments? Are we expecting to see a fiscal reaction to what's going on? I mean, I haven't heard that in Europe yet. We're certainly not talking about it here.
Not fiscal here. Certainly in China, there was a concern among market participants that China wasn't, Beijing wasn't really stimulating all that much, despite the fact that their economy was posting some of the weakest numbers they've had since the 90s. And there was a sense that the drive toward fiscal rectitude was keeping Beijing from doing the kind of stimulus on the fiscal and monetary side that a lot of market participants were kind of hoping that they would do. Well, now we've seen the Beijing response. We've seen rate cuts. We've seen, obviously, it's hard to track the fiscal numbers in China, but there are a lot of anecdotal evidence of big spending on hospital construction and some of the other things that are going on over there. There's a sense that Beijing and President Xi came out this week and said that we're going to both defeat the virus and meet our economic goals. And that basically tells investors stimulus is coming. Certainly, but for the virus, they wouldn't necessarily be stimulating nearly as much. And certainly, we had Fed Chair Powell talk about their readiness to confront the risks associated with the virus and the economic downside that it will engender.
Well, the question I have for you guys, as you're looking at the market, I mean, we talk about the markets as though and we are looking at sort of like the broad-based indices and how and where they are, but clearly it's impacting different firms in different ways. I think Caterpillar said I think they think that all of their factories are up and running and they're right now as of today after having some shutdowns, they're going to be back in good shape. Apple's not in that situation. There are a number of other manufacturers who are not in that situation where their supply lines are really impacted by what's going on in
exactly.
Wuhan. So
actually, John, yesterday you had interesting insights into or thoughts on Foxconn.
Well, there was, as you say, each company is different, and the supply lines are something that market participants are really interested in. Foxconn is one of they make chips and components for every, big, huge tech companies. They employ over 1 million people in mainland China, and they're being watched as the bellwether for the private sector response. There were stories earlier in the week that Foxconn would be targeting about 50% restarting its mainland output, 50% capacity by the end of the month. Foxconn management came out and said that those reports were inaccurate, but they didn't say how.
Which way
they were inaccurate. So clearly there's a pretty delicate dance, and Foxconn obviously has to manage the realities of working with the Beijing the authorities in Beijing and the rest of the country alongside their own economic goals. So it's as you say, it's a very interesting and case by case impact that we're seeing, and I think that brings us to a very important point, which is, yes, the equity market is going up. U.S. equities are going up, but not all sectors are behaving in the same way. When you look at the sectoral performance, there is a distinct flavor of caution. You can see that utilities are outperforming pretty dramatically a lot of the rest of the other sectors. Utilities are a very defensive sector. That's the place you go hide. Tech, tech has sort of been the investor, big Netflix and.
Well, it's really just from the four. Actually, it's the MAGA: Microsoft, Amazon, Apple, and Google are basically have driven about a quarter of the S&P rise this year. So it's not necessarily the whole market's going up.
Right.
It's really top heavy at this point.
Yeah, and at the same time, we're seeing utilities and kind of the tech leadership, which investors feel very safe purchasing. Those increasingly narrow leadership to the upside in the S&P 500, and that's put against on the Treasury side some really significant declines in Treasury yields, a big rally in Treasuries.
Yep.
And that is underwritten by risk aversion to some extent, underwritten by expectations that this is going to be an episode that really hits growth, and maybe the impact will be bigger than economists and sort of the equity crowd are thinking.
And also the big risk that it's difficult to quantify, but we know that China's sitting on a huge amount of bad loans. And the question is whether this corona slowdown accelerates the essentially come to Jesus moment where those bills come due.
There's certainly a sense that among the stimulus options that Beijing has, one of them will be leaning heavily on the state-owned banks to extend maturities to, basically bank forbearance. That's been a very consistent theme in the recent history of China. When they have problems, the banks are called upon to do national service.
And they're throwing a huge amount of liquidity into the system too, right?
Well, the liquidity injections have been pronounced over the last, basically during this outbreak scenario. And more is expected. The PBO, the People's Bank of China, the Central Bank of China, meets next week, and we expect some policy response out of that meeting.
Well, I think we're going to be talking about it again next Friday. I don't think this isn't going away for a while. Whatever the market impacts are and broader economic impacts are, we'll probably be leading off the show again next week with it, because I think it is going to be commanding headlines. Other headlines this week, well, not so much headlines. They weren't really headlines. We had the Humphrey Hawkins testimony of Chairman Powell.
Yeah, he kind of slipped through. Yep. Other than criticizing for partying with Bezos.
Yeah, what was that all about? I mean, that came from Elizabeth Warren. We'll talk politics later, but or was it someone else? Maxine Waters, maybe?
It was a congresswoman. I forget her name.
Yeah, I can't remember who it was. But so look, it's steady as she goes at the Fed. They're comfortable wherever they are with policy. You talked about their readiness to act if they think coronavirus or some other threat is impairing growth, but they're not really seeing it, and we're not really seeing it either right now. For in terms of long-term structural kinds of things, or cyclical kinds of things. So I think it's going to be steady as she goes for a while, right?
Well, that's certainly the impression that Chair Powell gave in his testimony, his 2-day testimony in front of both the House and the Senate earlier this week. He has clearly mastered the art of saying much without giving away very much. It was a very balanced performance, and the emphasis, I think, in the second day was interestingly on how the Fed plans to do additional easing when rates are already low. And
they really should start with the Senate. The questions in the Senate are a lot more nuanced than the House.
And that's a very important line of questioning. And Fed Chair Powell stated that they would aggressively pursue large scale asset purchases, also known as quantitative easing, or QE, which is the balance sheet expansion operation that floods liquidity into the market and has in the past been associated with equity upside and a lot of other rainbows and unicorns in financial markets. QE is very much on the minds of investors who are looking at the Fed's current asset purchase program as a QE light, and that there's a lot of debate around that. We've talked about that before. But just back onto the rates, the Fed is saying that things are steady as she goes, but the futures markets are pricing in over a 50% chance that the Fed is back to rate cuts by the middle of this year.
Yeah, which is amazing.
And there's more than one rate cut priced into futures markets over the next year, and that is not a vote of confidence in the U.S. economy, in the global economy. We're seeing yield curves, the spread between 2 and 10-year Treasury yields, but there are other segments of the yield curve. We're seeing some pronounced flattening. And yields are really, really low. We started the year at the 10-year was knocking on the door of 2%. We're at 1.57% now. That's really is really close.
So I guess we have to do our annual advice to our listeners to go refi your mortgage.
Yeah, yeah. So the Fed is. And when you look at the probability of a rate hike over the next year, it is absolute donuts, total zeros.
Yep.
And the Fed is basically it's a one-way street. They're either going to be sitting on their hands or they're going to be doing more easing, and that's.
Do you think? Yeah, I mean, look, I mean, most of the privates forget the administration forecasts, which are like you've got the Willy Wonka golden ticket kind of forecast. Yeah. Private sector forecasts are pinning growth dipping to below 2% later this year. Because CBO is there too, so 2% or lower for the year. Probably you could, with a downside risk because of coronavirus. Mm-hmm. So if that's what we see, right? If we're sitting here in the third quarter and we're looking at growth projected for the rest of the year in the 1.7, 1.8 range, do we expect to see a cut from that, or are we seeing, or is that a reversion to the mean a little bit, or correcting from an overstimulated couple of years?
Yeah, because while the GDP is say 1.5 to 2, no one's expecting the unemployment rate to increase significantly, and we're still going to be 175,000 jobs. So I totally agree to your point. When you just look at those numbers, that doesn't scream, "Oh my God, we got to stimulate the economy."
But the market does seem to be saying that, right?
Oh, totally.
That's what they're pricing in.
Yeah, so there's definitely a sense that the downside risk to the economy is that's a predominant risk at this point. Whether the Fed right now, I think the bar is not that high for them to do more, but we would really need to see. We've got to see the data as it's coming through the post-coronavirus. When we see that impact play through, I think that's really it's one thing to intellectually know that global data is going to suffer, but when we start seeing those dramatic declines in some of the data, particularly coming out of Asia and elsewhere, I think that's going to be kind of a gut check for policymakers.
Well, hey, that wasn't all that happened in Fedland. We also had a couple nominations that President Trump had sent up, and they had the confirmation hearings yesterday that had some fireworks. Why don't we take a break right here and come back and talk about Judy Shelton and the gold standard and see where these Fed nominees are going to go. We'll get into politics later. You're listening to the HPS Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
Hey, we're back on the Macrocast. Hey, guys, so it was an adventurous confirmation hearing yesterday. We had, Christopher Waller and Judy Shelton both appearing before the Senate Banking Committee, and I'm going to set Christopher.
He won the lottery. No one asked him any questions.
Confused him for Christopher Walken. He was pretty much ignored except to be asked about Judy Shelton.
Yeah, that was the only headline that he made.
Yeah, so Judy Shelton was,
and he kind of threw under the bus a little bit.
But I don't think he had a choice, right? I mean, what's he going to say?
It's a little awkward. He was sitting next to her.
Serious, experienced guy. That's the reason they paired them together, hoping that he can sort of drag her across the finish line. But look, I mean, Judy Shelton, we've been aware of her for a very, very long time. This is someone who decades long belief in the gold standard and hard money. She made a sharp turn in recent months or the past year as President Trump has been calling for, easy money and negative rates and critical of the Fed. She's gone right along with him despite decades of, having an opposite view. She's also very, very close to Larry Kudlow, a friend of mine, and I think Larry has sort of vouched for her and has encouraged her nomination. But it was met with a lot of skepticism yesterday, wasn't it?
Well, it's tough to get up in front of Congress and answer questions about your life's work. And 3 weeks ago, you completely decided you believe the exact opposite of what you've believed your entire life. So, I mean, it was a bit of a train wreck, but I don't know how else it could be, if you don't believe, now you believe in easy money. I don't know how you answer those questions.
Yeah, the sense that the Fed might be going into a politicized season is something that's the undertone of this.
That's probably the bigger
stepping back
thing to focus on this whole thing. Yeah.
Stepping back, thinking that having a fresh voice on the Fed, having somebody with views that are outside the mainstream, in basically generic terms, that is a very good thing. You don't want this is a very, very powerful institution. Some say the most powerful institution in the world, and
I think
Washington.
There is legit criticism that there's too many empirical economists on the Fed. You do want some outside views.
Yeah, and having a room full of conventional thinkers and conventional economists in kind of an echo chamber format. It's good to inject new views. I think there was some discussion really about whether she would be such a creature of the Trump administration. Would this be would she be the almost like the plant at the White House's plant at the Fed board? Questions about her support for Fed independence. Those were obviously very pointed parts of questions. I think that there's taking another step back and looking at what the Fed has positioned themselves as. They've since the global financial crisis, the Fed has basically been able to credibly say that they are the last resort, the backstop, the crisis fighters. But they've come in and ridden to the rescue of financial markets in a number of different ways and places, and they are credited, and certainly the Trump White House seems to believe this, that they can levitate asset prices with quantitative easing and rate cuts and that sort of thing. And if you believe, as a politician, that the equity market has to be going up for you to get reelected, and the Fed has the power to make equity prices go up, then thereby you have to do everything in your power to make sure that the Fed is on your side. And that's kind of the world we live in.
Well, I think that's the point of Judy Shelton, though, right? Look, if you ask me, like the White House isn't concerned that she had a view on, they're not interested that she had a view on the gold standard and hard money, and they're not actually particularly interested in the fact that she's now changed her view to be for easy money and and super low rates even in peacetime. What they really like about her is her willingness to have the view of the president, right?
100% agree.
Right, that's what she is. That's what she has demonstrated, is that whatever the view the president has, she'll have that view, and that's what they really, that's what they really like. I agree with you, and you want to see diversity on there. There are a lot of you won't have trouble finding a serious economist who has well thought out views on who thinks we should be in in a tightening cycle, right? I mean, I may disagree with it, and others may disagree, but there are serious economists out there who have a strong record, and maybe not serious economists who are who believe in the gold standard, but other views that we've been too loose with money, and there would be nothing wrong with having someone like that on the. Now, look, I've had a view that whatever, even if it is a wacky view, whatever her views are, she's only 1/14 of the Federal Open Market Committee, right? It's not right. It's not as though she's going to come on and
no, and really. If she made it onto the board, her views are so divergent from everyone else, and then also she flips, so kind of they would look down upon her. She would essentially be ostracized within the FOMC, but more importantly, if she voted against the committee or had different views, the market would essentially just dismiss her. Usually if someone votes against, the market pays attention and like, oh, what's going on here? I think the market would just completely eliminate that vote from the 14,
Right. Yeah, so I don't. Even if she does make it on, and I'm still leaning towards the likelihood that she's probably.
Yeah. So actually, can you explain to us how? Yeah.
So she's going to. So the committee there is skepticism on the committee, and a few of the leading Republicans, Richard Shelby from Alabama, Senator Toomey from Pennsylvania, have, and other members also. But
Kennedy hasn't really.
Kennedy was very skeptical as well. The chairman, Crapo, seems like he's inclined to move it forward and force a vote. So, look, I am still leaning towards the likelihood that they're probably going to confirm her, even with the concerns raised.
So how many votes does she need?
She just needs every Republican vote. I mean, she can lose a vote, and that's all. And
she can just lose one. Okay.
Yeah. So she can get confirmed, and it would be you have to keep the Republicans together. They can move it out of committee that way. That's not a confirmation. So have to get it to the floor where they have a little bit more leeway. They can lose a couple senators and still have leeway on her confirmation. And look, I wouldn't be surprised at it. The concern that people have had, and I've heard this, is that, well, she could be the next chairman. He could,
that's what the market is focusing a little bit.
Yeah, and she can't really become chairman. There's even a possibility, even let's say she's on the committee, and let's say she was chairman, right? FOMC chooses its own chairman. It's actually not, it's only by custom that the Federal Reserve Board chairman is the chairman of the Federal Open Market Committee. So they could actually. Oh,
that's really interesting.
They could maintain Powell as chairman, but let's say he tries to, he wants to appoint her as chairman, replace Powell, and make Judy Shelton chairman. That would require another confirmation vote from Congress. And as much as I can see this Senate confirming her to one of those spots on the board and becoming a member of the Open Market Committee, I do not see this Senate nominating her, or voting to confirm her as chairman of that board. I think even this Senate, if pushed to that, would not vote for her. You don't want to even have the possibility of that happening, but I think they would reject her nomination.
But that won't be for a couple of years, so it'll be.
Well, you can do it at any time.
It'll be President Bernie Sanders with the 60 Dems in the Senate by then, right?
That's right. Yeah, good point. Now, look, he can do it. He could, if she's confirmed next week. The following week,
he could.
The president could say, I am nominating Judy Shelton to be chairman of the Federal Reserve Board. She doesn't automatically become chairman. She has to go through confirmation to become chairman, in the same way that, President Trump nominated Jay Powell to be chairman of the Federal Reserve Board. He did not become chairman of the Federal Reserve, even though he was a sitting member of the Federal Reserve Board. He didn't automatically become chairman. He had to go through Senate confirmation and then replace Janet Yellen as chairman. So in fact, Janet Yellen could have remained on the Federal Reserve Board if she wanted to.
Yeah, it was lovely to see her in the office the other day.
It was nice seeing her in the office, wasn't it? Yeah.
There was a lot of buzz throughout the floor at HPS on that day.
Just another day at Hamilton Place Strategies, former Fed chairman visiting. So we'll see. We'll see where the vote goes, and maybe we'll have news on that next week. I know Crapo's saying he wants to move it quickly. Why don't we take our last break and talk about where we are with politics and see is it going to be a Sanders train? You're listening to the HPS Macrocast.
Hamilton Place Strategies is an analytical public affairs firm based in Washington, D.C. Learn more at hamiltonplacestrategies.com or follow us on Twitter at HPS Insight.
And we're back on the HPS Macrocast. Guys, there's lots of so we could do an entire show on the Democratic primaries, but that's not our show. But we'll talk about it a little bit. Bernie Sanders won his second state. He won. I'm sorry. Did he win Iowa? He won some votes in Iowa. Buttigieg won Iowa.
Who knows?
Buttigieg came in second. Yeah, who knows? Well, let's forget Iowa.
He did well.
Bernie wins New Hampshire. Buttigieg is there. A strong showing from Amy Klobuchar. But look, it's hard to not conclude right now that Bernie Sanders is the front runner. And, John, do markets believe it?
Well, it certainly seems like we're skeptical that broad markets, the broad S&P 500 or the Treasury markets or the dollar are really trading on this. It's the election is pretty far over the investment horizon. It has most of the hypothetical outcomes don't have that big an impact on. Won't have that big an impact on policy or the economic outlook, and so we look at, but we're much more sympathetic to the idea that specific stocks are kind of telling the tale more. And when you look through when you shuffle the deck of the S&P 500, UnitedHealth Group is one that is considered by a lot of analysts as a good proxy for President Trump's reelection chances. And this is because obviously Democrats have reached more of a consensus on healthcare reform that would be deleterious to UnitedHealth's business plan, and Trump's reelection would keep it, basically steady as she goes for UnitedHealth. And we can see last week UnitedHealth was up 7% when the Democrats had a pretty rocky week. UnitedHealth is up about 4.5%, popping on Wednesday after the results came out from New Hampshire. And with Bernie in the lead, and I think that basically suggests that Wall Street is excited about a Sanders candidacy because they believe that he can't beat Trump, and so that's why you would see UnitedHealth popping higher and rallying strongly on a Sanders win because investors are betting that Trump would prevail in that head-to-head matchup.
That's interesting. It's fun to watch, like how certain individual companies can expect to fare and how the market thinks about it. It is a fun proxy if you can screen out the noise of anything else that's going on. But I do think people think think people think about it that way. There's a lot of talk about the fact that my friend Ben White at Politico, Morning Money. Others, when he talks to people in markets, they are overwhelmingly expecting a Trump reelection.
Overwhelming, especially after New Hampshire.
Yeah,
right. And a lot of people are like taking a victory lap. It's kind of amazing at this point. We're in mid-February.
Yeah, that's not what obviously national polls say. Something a little bit different. But Wall Street has made up its mind, it seems. But it's easy for Wall Street to do that in February, right? If the as we get through Super Tuesday and the Democrat field kind of shakes out, winnows out, and then as we get closer to the election, it's harder to have that bravado, and there'll be a lot more
and I think Wall Street's
volatility associated.
Thinking it very simply, if Bernie's the candidate, Trump wins in a landslide, and also if Bernie's the candidate, Bloomberg probably actually ends up. If Bernie's the front runner, that raises the odds that Bloomberg can kind of sneak in and be the Democratic candidate.
Well, it is no doubt this has lined up well for Bloomberg. I mean, what Bloomberg, the best Bloomberg could have hoped for was split decisions going into Super Tuesday.
So when is Super Tuesday?
March 3rd.
March 3rd. Okay.
So it's coming up on us. We have Nevada caucuses and South Carolina primary between now and then, and so we'll learn more from that. But look, I mean, Joe Biden is he has called South Carolina his firewall. It's presumed that he will win South Carolina. He has had a disastrous showing through 2 states so far.
If he doesn't win South Carolina, is it over for him?
It's absolutely over for him. He has to win South Carolina. The money will dry up for him, and I think he'll be done if he does not actually win and win convincingly. I think in South Carolina, so that's critically important for him. If that doesn't happen, but even if it does happen for Bloomberg, if he ekes out a win in South Carolina, so now I have a third winner. Somebody, whether it's Biden, Bernie, someone is going to win. The Nevada caucuses, but what happens in Vegas stays in Vegas. It's not going to have a whole lot of influence elsewhere. It's not that big a deal and not a big momentum boost. So, but what you are going to see is these sort of split decisions going into Super Tuesday. An incredibly expensive, broad day for these candidates, and he's the only one with resources. So we'll see whether he can, enter the race at a level that will allow him to be credible going forward. It certainly won't, if he doesn't, it won't be for lack of resources.
Yeah, I also think it's interesting where Wall Street's okay with Bloomberg, but I think they think he's a Republican in sheep's clothing. But if you actually look at his platform, he's a pretty straight down the middle Dem candidate. Platform.
Yeah, I think those criticisms of him as a whatever you don't have to like Mike Bloomberg and I think he's a good guy, but. Yep. But let's be clear. Like the idea that he's some kind of closet Republican is just bonkers. I mean, he's pro gun control, he's pro immigration, pro choice. He's fought for teacher pay and funding for public schools. He is as far to the left as anybody in the Democratic race on climate change. The idea that there's that he would find a place in the Republican Party is just goofy. He's in the right party. And,
right. Yeah. It's not a criticism. It's just telling people the truth.
But you've heard this from some of the other camps.
I totally agree.
Who have been critical of him, saying that he's he's really a Republican. It's just goofy. He's not a Republican. Democrats can decide whether he's a Democrat or not. But
right.
Let's be clear. He's not a Republican.
No, I agree.
Yeah. Hey, what data do we have next week? What are we looking at?
Yeah, so not a too busy week. In the U.S., we have some housing data, and then also globally, we get the first print of the February market PMI data. So we get Asia, U.S., and also the European ones, and then we get the Fed minutes from the last meeting, but that's kind of muted now because Powell testified this week, so we've already got a new update, so that's kind of stale. But probably the most interesting thing is the People's Bank of China will decide on their benchmark one-year loan prime rate. So about 6 months ago, they created this, and they kind of shifted the benchmark standard to this. So it's kind of an underreported, very big, central bank decision. It's currently at 4.15%, and over the first 6 months, they did cut it 3 times. So now with the coronavirus, it'll be. I think the markets are expecting another cut, but it'll be interesting to see, how aggressive they are.
All right. Well, we'll be back at it next Friday. Guys, have a
long weekend.
Have a wonderful long weekend. Have a lovely Valentine's Day today and this evening with your loved ones. And we will see you next Friday.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.